All right. So very good morning, guys. I hope I am audible. Please confirm once. Boys and girls on live. Please confirm. Am I audible? Say yes or no on the chat box. All right. Good. Thank you. Good. So hearty welcome to all of you for this session post lockdown. I would say it's not post pandemic because the pandemic is not yet done. So post lockdown, I think this is the first batch we are conducting personally live, and also there are few people present here in person. What we would do is I'm going to share you across what would be done during these sessions here, and then we'll also discuss how presentation in the examination has to be done. How do you understand the concept better? So these are few things which we will learn during this next 2 months or so. Just to understand, you are attempting for the May or November attempt? May. You? November. Okay. So, and I think most of the students attending live are for November, right? Yes. Okay. So I'll first take you through what syllabus do we have. Before that, we will understand we'll first understand what's there inside the first paper, which is accounting, and then take you through what has to be done going forward. Okay. So broadly, are you able to see the screen there? Not yet. Just give me 1 minute. Yeah. So broadly, this is what we have as syllabus. First of all, in foundation, you have only gone through what accounting standards you have, basics of accounting, basics of company accounting, basics of partnership. This is what you would have gone through. But intermediate, this is the syllabus what you have. IGAP indicates Indian Generally Accepted Accounting Standards, IGAP. I'm referring to this part. And then Ind AS, there is something called Ind AS, which is specifically applicable for few companies. I'll discuss when it comes. And IFRS is globally recognized standards, which we call as International Financial Reporting Standards. So the differences between each of these three is something expected at intermediate level. And then framework of preparation and presentation of financial statements. And then comes accounting standards. In accounting standards, you have all these topics. So first, disclosure of accounting policies, valuation of inventories, cash flow, property, plant and equipment, effects of foreign exchange, government grants, investments, borrowing costs. I'm strictly sticking only to group 1 what syllabus you have. I'm strictly sticking to group 1 syllabus what you have. In group 2, there are more standards which are supposed to be covered. When we go there, we will discuss those. Okay. Now, and company accounts, if you see, the company accounts in the group 1 is very restrictive. It's more about the preparation of financial statements, understanding how managerial remuneration is to be distributed amongst the company's directors or employees, CEOs and all. And then there's something called profit or loss, prior to incorporation, if there is any profit or loss, accounting for bonus issues, rights issue, preference shares, debentures. These are few important aspects which are there in company accounts. Okay, accountings for special transactions. These are specific instances where special guidelines are given for accounting. These also will be covering. And lastly, there are special types of accounting called department accounts, branch accounts, incomplete records and all. Okay, so in total, if you see, there are 22 topics for us. However, if you look at company accounts first part, this part completely, preparation of financial statements, statement of P&L, balance sheet, cash flow statement. Fairly speaking, P&L balance sheet, you are aware for individuals all these years. Yes or no? Be it in your +1, +2, you have been going through this. Company accounts is what we are going to look through now. Apart from that, preparation of cash flow statement is also something we'll be looking at. There's a separate standard for it. If you observe here, third item in accounting standards is cash flow statements. So theoretically, we would learn what's cash flow statement in accounting standards, and practically we would see in company accounts how cash flow statement is going to be prepared. Okay? So broadly, this is what we are going to cover over this next few days of classes. Second, coming to how the classes would go. Number one, I want you guys to be here by 6:15 sharp, or be it on Zoom or person. It's depending on what you are joining. 6:15 sharp. I'll definitely start. Today being the first day, I know difficulties in trying the place and all. It's okay. Or else for you to get up early in the morning, sit across live on Zoom and all is slightly difficult, I know. So 6:15 sharp, we will start. Second, have few things handy. When you come to class, think like you're coming here to write an examination. Every day should be a learning for you. Every day you should go out only with some learning. For that to happen, there are a few things which I would request you to do. Number one, notebooks. Prefer bringing only ruled books. Maybe there could be few who are comfortable writing in white notebooks. I don't deny that it's beautiful, but the problem here is CA examinations happen in ruled papers. Reason why CA exam has stuck to ruled papers is someone who tries giving more spaces, he'll now get accommodated into writing in lesser spaces. Otherwise, it's in our hands to give broader space and keep writing stories. So to avoid that, to limit that number of lines and all, rule lines are given by institute for examination, and I want you to abide only to that, so that examination, it would not look new to you. It looks very habituated if you write it in ruled books right from now itself. Second, I want you to carry blue or black pen for your regular classroom writing. Apart from that, red ink, green ink are important, are equally important. And apart from that, the highlighter, if you feel something is important specifically for you, I want you to highlight whenever we discuss notes and all. Okay, what is the importance of red ink? I'll tell you. Problems I will do on screen. But before I do on screen, I will give you an opportunity to do it by yourself. You should first try experimenting by yourself. If you fail in that, I'll help. Okay, but you should know where you have failed. Yes or no? You should know what your mistakes are. So to identify what your mistakes are, that red ink is something which will be useful. Okay, so what I'm going to do is I will do the problems. I'll personally solve all the problems along with you, but First, I'll give you a chance. I would ask you whether you have got the correct answers or not. Only then I would be sharing the correct answers with you. Okay. So this is the importance of red ink, green ink, and highlighter. By the way, green ink I have not told you. Green ink is to write down whatever special points you have learned in a problem. For example, financial statements, final accounts preparation. Say you have for now gone till how P&L is to be drafted. There are few special items called carriage inward, carriage outward. Where do we identify carriage inward? Where do we identify carriage outward? I'm just giving you a few examples. So be specific as to where and all we are supposed to highlight new points. Okay, so that's the idea behind why we need red ink, green ink, and highlighters. Yep. And apart from that, keep your calculators with you. Don't use mobile phones to do the calculations. I'm strictly against that, because examination you will not have the comfort of carrying your mobile phone. So definitely carry your calculators along with you, and only then start working. Okay. So broadly, this is what I wanted to convey as to how the class would go forward. Okay. And coming to today's session, today being the first day, I do not want to dump in too critical topics on the first day itself. Let's start something simple. And going forward, slowly we will increase the standards. Clear? Hello, everybody online. Are you guys following? Yes or no? Okay, thank you. Cool. So let's get started with a simple topic today called profit or loss before incorporation and after incorporation. I am not going to do in the sequence in which institute material is given. I might do that chapter first, this chapter later and all. But end of the day, when you holistically look at the subject, everything gets covered. That's my promise. Okay. I might do one chapter first, one chapter later and all. That shouldn't be a problem. Reason is very simple. At times I would do only for, I might complete a topic in the first 1 hour of the session. Next 1.5 hours, I don't want to start something bigger. That 1.5 hours, I'll swap with something small. So with that intention, I might pick up smaller topics at times, bigger topics at times based on my time convenience. Okay. So this is what we are going to do. Now, so to start with, we will begin profit or loss prior to incorporation. I'll open a OneNote for you guys. So I'm going to show you how your examination paper would be. You would do it in the same lines. I'm trying to say about how your answer sheets generally looks like. All right. So your examination paper comes in this size. Just wondering why my pen is not writing. It's fine. We'll see. Okay. Yeah. Pre-incorporation and post-incorporation profits. Now, what do you mean by pre-incorporation and what do you mean by post-incorporation profits? First, let's understand what this concept is, and then we will get into the, writing the theory notes and doing the problems. Number one, at times companies start business after incorporating. That means they would have their own structures and then start the business. Compliance wise, they'll first set up everything and then start the business. In such case, every profit made by the company is basically a revenue profit. So, but when it comes to a company getting incorporated and acquiring another company which is already in existence, in such case, the profit what is earned by the existing company cannot be called as my profit as well. Boys and girls on the line, you also should keep responding to the chat in the chat box. Okay. So, yeah. So what we need to know is there could be instances where a company is incorporated and it takes over some other existing business into that company. In such case, the profit earned by such company cannot be called completely generated by that company. Reason, there is some effort which is put in already by the previous owner of that business. So since you have taken over that owner's business into yours, you would need some extra, there is some profit which you have earned, which you have not actually worked for, right? So that is what you're supposed to understand. And that profit, whatever is identified, which happens to be before my incorporation, I cannot call my profit. How do I treat that in my books of accounts is the question. How do I treat that in my books of accounts is the question. Okay. Now, you might keep scribbling if you want, that's fine. But at the end of discussion, I will give you some notes for you to write. Okay. That notes is sufficient for you along with the problems what we solve. Okay. Now, how do we deal with such pre-incorporation, post-incorporation profits? First of all, there would be instances where, say, there is a entity which is in existence from 1/4/21. There is an entity in existence from 1/4/21, which is into XYZ business. I'm not interested in the business. I'm more interested about the concept and what profits they have made. It has been operating for quite some time, and in between, on 30th of September 2021, I and my friends started a company. And we liked the business what they are doing. We thought we will also do the same business. But all of a sudden, what we felt is, instead of starting all by ourselves, why can't we take them over and build it together? Yes, no. Instead of 1 plus 1, bring them in, join hands together, build it bigger. Okay. So in such case, on 30th September, I have incorporated a company and taken over this existing company, whatever is there, into my company, taken over this existing business, whatever is there, into my company. Now that means for the financial period 1/4/21 to 31st March 22, there is business in the company. However, this entire business, what is done in this financial year, cannot be called as done by my company, yes or no? Okay. I'll have to identify what is the business generated before the date of incorporation. I'll have to identify the business, what is there after the date of incorporation. To the extent of business done after the date of incorporation, it will fall into my books only, into my company's books only. That prior period items, whatever are there, that prior period revenue items, whatever are there, I'll have to prepare a separate P&L for them, and tell that, boss, for the business which you have done till 30th September, this is the profit what you have made. Or else I will have to tell this is the loss what you have made. So that means I will have to either do it this way. Number one, prepare P&L, separate P&L, in fact. Separate P&L from 1/4/21 to 30th September. And second P&L would be from 1st of October 2021 to 31st March 22. This is one way in which I can do. But fairly speaking, for the same financial period, preparing two statements is too tedious. So, hence, this concept called, you don't prepare two separate statements. At the end of the day, what is that I want? I don't want you to prepare two separate financial statements. I just need to know what is pre-incorporation profit, what is post-incorporation profit. That's all. Hence, what suggestions we have got is, we will prepare only one set of financial statements. We'll prepare only one set of financial statements. That means post-incorporation only. But we will, within the financial statements prepared, we will try analyzing how much is pre-incorporation, how much is post-incorporation. Okay. So within the same set of financial statements, we are going to segregate pre, post. That's all. Yeah. These are the two things which you will be doing. Now, what is the objective in identifying pre-incorporation profit and post-incorporation profit? I want answers. You also. What is the objective? Why do you think we have to do this tedious exercise? I do agree that pre-incorporation profit is there, post-incorporation profit is there. For what purpose? Excellent, excellent. The company has not done anything. How can you share the profit with the existing shareholders? Okay, how can you share the profit with the existing shareholders? That's not appropriate. Okay, so there is an answer here so that both the companies may get justice. Bilal, good answer. Okay, so it's basically to understand how much profits the prior parties made, how much profits I have made after this incorporation. That's all. Now, in this scenario, the very purpose of identifying pre-incorporation profits and post-incorporation profits is, there is some profit which is getting generated before the date of incorporation. At times, the previous owner of that business might ask you to give the profit to him. might ask you to give that profit to him, in which case he'll take the profit and leave it off. No difficulty in that case at all. No difficulty in that case at all. But at times what happens is, when I buy over the company, but when I buy over the business from the other party, I would tell, look, take this 50 lakhs, including profit. Think that he's including profit for you. Don't come back to me and tell that last 6 months I only put that effort. No, pay me some profit out of that. No, don't ask me anything. You come here, take this 50 lakhs, go, forget about your business. But the fact is, the worth of the business could be just 40 lakhs or 45 lakhs. Or else after investing the 50 lakhs, you might have made a profit out of the pre-acquisition period for 5 lakhs or 10 lakhs. In my existing new company's books, how do I show? Is the question. Yes or no? How do I show in my new company is the biggest question. Now the problem is, if it is a profit which is earned after my date of incorporation, I will take it to P&L, very smooth case. But if it is something which is earned by me before the date of incorporation, that is not a regular profit. That's not a recurring profit. That's a one-time profit. Yes or no? Now, what do we call one-time profits in accounting? Very good. Okay, we take it to reserves. There is some word for that profit. What profit? You already mentioned. What profit is called? Excellent. It's called as capital profit. Now, something which we make once or which is not recurring, is what we call as capital profit. Such capital profits, you cannot take it into P&L. You cannot take it into P&L. Hence, the requirement is that profits are supposed to be taken to capital reserve, and then we would accordingly account for it. Now, you may ask, sir, why are you always stating there will be only profit? There can even be losses. So, now, what does prudence say? Prudence. Long ago, when you did your foundation, CPT or whatever. What? Provide for all possible losses. Good. Okay. So now, what if there is a loss? What if there is a loss? Companies Act has given you two options. Number one, charge it off to your P&L. Charge it off to your P&L because this is a loss incurred in the current year only. Okay, charge it off to your P&L. Or else, if you feel you don't want to charge it to the current P&L completely, create goodwill. And show it as part of your assets. Write off over period of time. Okay. So these are the options what you have from company's point of view. If the profit is left to you by the previous owner of the business. Is this clear? Okay. Now, what I'll do is, I'll give you notes which is relevant for you. Okay. Then we will go ahead and see problems. Okay. How do we do problems is what I'll first discuss, and then we will solve the problems. Yeah. Now, I will disconnect my Bluetooth, otherwise it keeps on making sounds. Right. So please take down notes. Yeah. Introduction. So take main heading, pre-incorporation, post-incorporation profits. Main heading, pre-incorporation and post-incorporation profits. Okay. In that introduction. When a company gets incorporated, and starts business afresh, comma, all the profits made are its own revenue profits. Full stop. Next slide. However, comma, when a company is incorporated and takes over an existing business, when a company is incorporated and takes over an existing business, comma, the entire profit made during the year might not be generated by company alone. Full stop. Next line. There could be profits earned because of the efforts put in by previous owners of the business. Comma, during the pre-incorporation period. Okay, full stop. This chapter deals with how accounting should be done for such pre-incorporation profits and post-incorporation profits. in brackets losses. Clear? No. Next slide. Leave a line and then next line. Okay. Leave a line and then next line. Take it like this as I do. Okay. I think you can see in the screen. This is a financial year. Okay. 1/4/21, 31st March 22. Okay. In between, draw a line. This date is basically 30th of September 21. Here write down date of incorporation. Date of incorporation. Okay. Now, this period is called as pre-incorporation period. This period is called as post-incorporation period. Okay. Now, next. So after that small diagram, let's come back. In the center, please mention like this: pre-incorporation period. Pre-incorporation period. Okay. Take off two parts. In pre-incorporation period, there could be either a profit or a loss. There could be either profit or a loss. From profit, pull a down arrow. From profit, pull a down arrow and write create capital reserve. Okay. If loss, take off again two parts. Take off two parts. First part, charge to P&L. Charge to P&L or recognize goodwill. Recognize goodwill and write off over years. Clear? So this is what to do with pre-incorporation period. Next line, just mention post-incorporation period. Post-incorporation period, again two parts, profit, loss. Okay. Bottom flower bracket, both together, bottom flower bracket, and write recognizing P&L. Okay. Now, we now know what has to be done with the pre-incorporation profits, pre-incorporation loss, post-incorporation profit or loss. but we have not discussed till now how to calculate or how to compute pre-incorporation, post-incorporation profits. For that, let's go ahead now. Generally, P&L would be like this. I'm just giving you a rough estimate. There would be sales, there would be other income in P&L, there would be opening stock, there could be purchases made, there could be carriage or some other expenses, manufacturing expenses. At the end, you make some profit called as GP. Okay, and from GP you would continue again. Okay, you would take all other expenses, salaries would be there, then maintenance would be there, there would be office expenses, there would be petrol, whatever, blah 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 expenses. At the end of all these expenses, you would arrive at something called as net profit. You are trying to segregate this net profit into pre-acquisition period and post-acquisition period. What is the basis for it is the question. What is the basis for it is the question. Now, to identify basis, there are a few special parameters. Number one, sales you may recognize based on months, because sales are actual information which have happened in the company, right? Sales are actual information which have happened in the company. If there is something actual, you need to identify how much actual sales has happened pre-incorporation period, how much sales has happened post-incorporation period. That's important, right? So for sales, you're supposed to go by actual turnover based on time. That means pre-incorporation period, how much is the sales, how many months, how much turnover, post-incorporation, how many months, how much turnover. Next, sales is over. Other incomes could be there, like interest income. Generally, interest income is based on time only, no? We calculate interest based on time. If we say 9% per annum, what does that convey? Per month, it would be less than 1%, 0.75% or so. That's all, right? So that means interest is also something calculated based on time basis. Okay. Similarly, there would be few costs what we incur. There would be few costs what we incur. What type of costs do we have? There would be costs based on sales. For example, selling and marketing expenses or advertisement expenses, like how you stated. Is this something relevant to the sales which have happened? Right? What does that convey? Based on the sales, whatever sales are made, to that extent, proportionately, I would take these expenses. Right? So, in such case, sales ratio would be more appropriate at times. Or else, few expenses would be there which are time bound. For example, rent. Rent you will have to calculate based on time because it is standard, it's fixed. Every month 10,000 is the rent. That means for the number of months for which it is pre-incorporation period, for so many months I should take it to its pre-incorporation. For post-incorporation, I would take it to post-incorporation. There is no debate on this at all. Okay. So what is important for you is there would be few incomes you would recognize based on turnover ratio. There would be few incomes which are supposed to be recognized based on time ratio. At the same time, there would be costs what we incur, few based on turnover ratio. There would be costs which we incur, few based on time ratio. Apart from this, there could be few expenses which are specifically only for the pre-incorporation period. There could be few expenses specifically only for the post-incorporation period. What expenses can happen? For example, there is audit fee payable. Now for Companies Act, under Companies Act, audit is mandatory for every company. In which case, if it is statutory audit fee, it is supposed to be taken only as part of post incorporation period. So there would be something called as tax audit. But tax audit, if you see, is applicable based on the turnover made. If the turnover crosses a specific norm, then tax audit is applicable. In which case, tax audit is supposed to be distributed not just for post or not just for pre. You're supposed to decide based on the turnover made during those periods. That means it is based on turnover ratio. Okay. At times, what happens, he would specifically mention the question stating that there is interest cost. There is interest cost, which is specific only to pre-acquisition period. Okay. He would give you additional information about it. In which case, interest cost, you cannot take it to post-acquisition period. No, in such case, you should specifically take it only to pre-acquisition period. Okay. These are kind of few things which you are supposed to look at. Say, for example, and I'll keep adding more examples so that when we do problems, it would be easy for you. Okay. Say, I have taken over an existing partnership firm into company. Partnerships firm's business is what I've acquired. Now, in partnerships P&L, there would be something called as partner salary. What does that convey? That is salary paid to partners only during pre-acquisition period. In which case, that cannot be taken to post-acquisition, yes or no? In such case, we would take it only as part of pre-acquisition. Okay. There would be something called director remuneration. Now, in what do you see directors? Only in companies, yes or no? In which case, director remuneration is something which is paid only in company after incorporation. Hence, it is supposed to be considered as post. Very good. Here, this is the basis for you to appropriate your each item in P&L into pre and post. What are the types? One is based on sales, which is turnover, or else based on time. Maybe it's possible to give you a mix of these two, a combo of these two. Apart from that, specific cases, he would specify what to do with what. Okay. These are broadly what we have in types. Yeah. So with this intro, just write down another few lines about this as well. Boys and girls online, attending from home, sitting at comfort, maybe sleeping also, I don't know. Are you guys following? Respond. Yeah. Write down. Computation of profit or loss. Computation of profit or loss. Hyphen. Basis of apportionment. Okay. Basis of apportionment. So in that, write down. To compute profit/loss, to compute profit/loss, comma, the income and expense during the year. The income and expense during the year. should be split between the pre and post incorporation periods. Should be split between pre and post incorporation periods. Full stop. Next line. For that to happen, comma, basis of apportionment is to be identified. Full stop. Next line. Apportionment can be done in the following ways. Apportionment can be done in the following ways. Okay. From there, take off 4 parts. 4 parts means from the line, whatever you have written, take off 4 parts like this. 1, 2, 3, 4. Okay. 4 parts. First part. Sales ratio / turnover ratio. Second part, time ratio. Third part, combination of 1 and 2. Fourth part, as prescribed in the question. As prescribed in the question, in brackets, based on facts. Okay, based on facts. Below that, write down examples. Examples. Sales hyphen. What ratio would you take? Turnover ratio or sales ratio? Yeah. Sales ratio. Okay. Below that, other income. In brackets, write down. Sale of byproducts. Sale of byproducts. Now, if it is sale of byproducts, what would happen? If it is sale of byproducts, what would happen? What ratio would you take? It's again sales ratio only, no? See how much amount of byproduct I get is completely based on the sales what I make. Based on the products and what I make. Okay. Fine. I can't avoid that. It's completely based on sales what I make. Okay. So next. Other income in brackets, interest earned. Interest earned. Hyphen what ratio? Time ratio. Very good. Time ratio. Okay. Next line. Purchases. Purchases. Yeah, what ratio? Purchase would be time based or based on the sales what you make? Based on the sales what you make. Generally, purchases are dependent on how much we can sell. Yes or no? Based on the amount of sales what we can make, we will try to purchase. So generally it is sales ratio unless they specifically give any circumstance. Okay. So purchases hyphen write down sales ratio in general, comma, unless otherwise specified. Unless otherwise specified. Got it? Next. Carriage inward. Carriage inward. Then selling and distribution expenses. Next line. Selling and distribution expenses. Commission on sales. Okay. Bad debts, brokerage, promotion, okay, all these items put a right side floor bracket. Put a right side floor bracket. What are these dependent on? Sales only, because based on the sales what you make, you keep incurring these expenses. These would not be inversely proportionate. These would be directly proportionate to your sales. Okay, so all these put together, right side floor bracket and right sales ratio. Sales ratio. Okay. Then what other expenses would you generally have? Next line. Fixed common expenses. Fixed common expenses. In brackets, write down rent, comma, salaries, printing and stationery, etc. Okay. On the other side, again, for all these put together, floor bracket, right side, it's what ratio? Time ratio. Very good. Time ratio. Then, now I have a question. How do you do depreciation? What? Over a period of usable life, huh? Useful life. Okay. Useful life is fine. No? I'm asking about pre and post incorporation. How do you differentiate? Time ratio. Why time ratio? Not based on sales. Okay, very good. So generally depreciation is based on time because depreciation is charged for the number of years or months it is available for use. It is available for use. So in this case, throughout the 12 months, it could be available for use. In such case, it is based on the time ratio, not based on months it is used for. Okay, it's available for use, which is important. So in that list of time ratio, please add depreciation also. Okay. Next. Expenses specific to pre-incorporation period. Expenses specific to pre-incorporation period. Bilal, I will answer your question. I'm really happy about the kind of qualitative question you are asking. What if it's production unit method? Very good. Good. Okay, so what were we talking about? Expenses specifically related to pre-incorporation period, right? So what do? Take it only as part of pre-incorporation expenses. Okay, hyphen on the other side, uh, expense only in pre-incorporation P&L. Expense only in pre-incorporation period. Okay, next line. Expenses specific to post-incorporation period. By the way, we have not written examples for pre-incorporation period, no? Okay, just try tweaking in there and write examples. Partner's salary, comma, interest paid, etc. Okay, next line. This expenses specific to post incorporation period. Examples: director's fees, auditor fees, auditor fees, preliminary expenses, okay, underwriting commission, etc. Of course.
So then how they say that they get acquiring existing business without incorporation, we can acquire that business.
I incorporate and then immediately acquire something which is in existence. It's possible. We can do that. Okay. And then explain. So with this, we are done with normal time-based sales ratio and all. What is pre-incorporation? What is post-incorporation? Next slide now. Special cases. Special cases. Example. Tax audit fees. Tax audit fees. Hyphen. Based on turnover. Okay. Next slide. Interest on purchase consideration. Interest on purchase consideration to vendor. Okay. In that, write down for the period up to date of incorporation. Hyphen pre-incorporation. Okay. Next line. From the date of incorporation. From the date of incorporation. Post incorporation. Yeah, it's similar to time ratio. Okay. So this is how we look at identifying pre and post. Now, having discussed the theory part of it, let's quickly pick up a couple of problems and do for today. I will not stress too much for today. Okay, we'll pick up a couple of problems. take out the material which I have shared. I have guys online. I have already shared it to you on WhatsApp today morning. Please take out that material, open that. Before we get into this, Bilal's question, let me answer. He was asking depreciation, what if it is based on production of units method? No, wrong. Absolutely fake question. So in such case, based on the number of units produced, you are supposed to charge depreciation into pre-acquisition and post-acquisition period. Say, for example, across the year, 2,000 units are produced. And out of that, 1,500 units are produced only before incorporation. And 500 units are produced after incorporation, in which case you take 3/4 of the depreciation to pre-acquisition period and 1/4 of the depreciation to post-acquisition period. Bilal, answer satisfied? Thank you. Very good. I'm happy about the interaction which is happening, though you guys are online. Yes. So let's go ahead with the problems. First question, let's keep it aside. We will discuss a little later. Take up the second question first. I will show it on the screen for you people. Here's the second question. Okay. I'll read it out. As I read, yeah, there are few inputs which I always would like to give in the first class. As you read the problem only once with absolute concentration. Read the problem only once with absolute concentration, and all the numbers, I wouldn't say blind-heartedly, by hearting the numbers, but my intention is your eye should directly go to that number whenever there is requirement to pick that number. Okay, so your concentration of reading should be so keen. Read it once with whole heart, understand in the first go. Reason, you should train your mind and heart according to the examination from day one. You should train your mind and heart for the examination right from day one, for which you need to learn these few habits, get accustomed to those. Okay. Now, please read. Rama Udyog Limited was incorporated on August 1st, 2021. It has acquired a running business of Rama and Co. with effect from 1st April 2021. During the year 2021 and 22, the total sales were 36 lakhs. The sales per month in the first half year were half of what they were in the later half year. Listing. It did not tell you what it is. Net profit of the company is 2 lakhs, worked out after charging the following expenses. Depreciation, 1,23,000, directors' fees, preliminary expenses, office expenses, selling expenses, interest to vendors up to 31st August 2021, 5,000. Please ascertain pre-incorporation, post-incorporation profit for the year ended 31st March 2022. Now, every question you will have a learning. Every question you will have a new learning. In this question, what is learning for you is, he did not tell you what is the sales ratio. He told you that indirectly. You should first know what that sales ratio is, only then you can go ahead with the problem. Clear? So first we'll have to find out what the sales ratio is. And anyways, we know what time ratio it is. I bought the business from 1st of April, but I incorporated company only from 1st of August. That means till September, first 6 months, I did not incorporate the company. Any profit earned till 30th September is pre-incorporation profit. Profits earned after incorporation is basically my profit, which I'll take it to post-incorporation. So my time ratio is very clear. First April to 30th September is pre-incorporation period. First is 4 months. Huh? It is 6 months if I am not wrong. First April, May, June, July, August, September, 6 months. Yeah, that's what time ratio. First 6 months is pre-incorporation and August. Oh, is it? Acha, okay, fine. August is okay. Even before September, I'm sleeping maybe. Fine. So first 4 months is pre-incorporation period. April, May, June, July. 4 months is pre-incorporation. 8 months is post-incorporation period. That's fine. And coming to sales ratio, we are supposed to find out. And then go ahead with the problem. Clear? So that means while you present your answer, you should first come out with what time ratio is, and then what sales ratio is, and then prepare the solution. Okay. What I'll do is, in the same notepad, I'll show you how the answer is supposed to be. Okay. We will go in the lines in line with the examination, how they expect us to present. Okay. Now, any problem, if even if you're doing the smallest working note, for example, you would like to tell 2 plus 1 is 3, that also you should put it on paper. Intention is very simple. Be it foundation level, intermediate level, or final level, ICAI expects you to put down on paper, and there are marks awarded for every step. Okay, so prefer writing everything down. Make it easy for the evaluator to evaluate your paper. He should not think that you have directly written an answer peeping into your neighbor's book. Okay, that should be the ultimate objective. He should think that you know everything out of it. For that to be present, even a smallest discussion or a smallest detail which you would like to give, put it on the paper. Clear? Now, so with this intro, let us start solving this. I'll do it along with you, since this being the first problem. Next problem onwards, we will first do by ourselves, and then we will share the answers with each other. Okay. Yes. Always make it a habit to write problem number in the center of the page. Problem 2, page number 1. Okay, whatever. I mean, you should have references both in your notebooks and also in your material what I share. Okay. In the notebooks, I'm sure you guys have places to write your page numbers nowadays. So serially note down the page numbers and the page number in which the problem is solved. Get it written in your textbook material what I'm sharing, so that you have reference in both the places. If you would like to cross verify, you should be able to immediately open it out. You should not search for the solution. Okay, so make this a habit right from day one. It makes a lot of sense. Yeah. Now problem 2. Let's get started. Working note number 1. Working note number 1. Time ratio. Okay, time ratio. He has stated pre-incorporation period. Pre-incorporation period as, what did he tell you about the pre-incorporation period? Pre-incorporation period is from 1/4/21 to 31st of 3rd. Okay, 1st August. All right, fine. 1st of August 21. So this is basically 4 months. Okay. And post incorporation period is from 1st of August 21 to 31st of March 22. Okay. So this is basically 8 months. Okay. So that means time ratio is basically 4:8, which I can also call as 1:2. This is the first step. Working note 1 over. Next. Are you guys doing along with me? Boys and girls online, please respond. All the 40 people out there, please keep participating, guys. Okay. Next. Working note 2. Working note 2. Before we go there, we will read that part once again for your clarity. We'll read that part once again for your clarity. What is he stating there? The sales per month in the first half year were half of what they were in the later half year. I'll repeat once again. The sales per month in the first half year were half of what they were in the later half year. Now, if you carefully see, that's actually English. You need to understand English and identify the ratio, that's all. In case he has given you too much of English like that, put down numbers like this. How many months you have in a year? 12 months. Yes or no? Take 12 months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. What is first half till here? Okay. In the second half, it will be 2 times of what is first half, is what he's saying. That means if it is 1 in each of these months in the first half, it is going to be 2 in the second half. Okay, this is it. Now, please see carefully. This is done for the year as a whole. But my pre-incorporation, post-incorporation is not exactly 6/6. So it is actually here, cutting off here. So it is basically 4:1:4. So this is 6 months, no? 6 to 12 plus 2, 14. 4:14 is my ratio. Or I can also call it as 2:7. Are you guys able to follow? Hello, Gutti Pasangals. Respond. Okay. So please take this. Please take this. Please take this. Please let me know if you're done with the working note. I'll repeat once again, no problem. He has given in the question stating that the sales in the second half would be twice of what is made per month in the first half. So if he has made 1 in each month in the first half, it would be 2 in the second half. Okay, so this is what he has given you with respect to sales. Clear? Now, If it is 1 in the first half, it is 2 in the second half. This is clear. That means, say here, he has made 1 lakh every month in the first half year, first 6 months. It's going to be 2 lakhs in the next 6 months. So this is the basis of sales which has happened, the trend of sales, what has happened. But the trend is not completely what we want. We want exactly how much amount of sales has happened in the pre-incorporation period, how much is what has happened in the post-incorporation period. For which what I need is, I will have to identify how many months is pre and how many months is post, for which these first 4 months is pre-incorporation period and the next 8 months is post-incorporation period. Sum of both these is what we have taken as ratio. Sum of both of this is what we have taken as ratio. So first 4 months is going to be 4 and sum of all these remaining 8 months is going to be 14. Please count if you want. There are 6 twos, which is 12, along with these 2 ones, which is 14. Okay. So 4:14 is the ratio. In short, it is basically 2:7. Clear, Pavitra? No response? Okay. So now that we are done with sales ratio and times ratio, let's go ahead to the problem. Let's go ahead to the problem. There is one more twist here. Did he tell you the sales? Did he tell you the sales? What is the sales? 36 lakhs is the sales what he has told. Fine, decent. But did he tell you the cost of those sales? He did not tell you. That means for me to prepare a proper P&L, it would be difficult. The problem is he has given you details like this. He has told you sales 36 lakhs. Okay. He did not tell you the information which is required for me to arrive at GP. The debit side of P&L, he did not tell me anything. How do I calculate? How do I calculate? I would do it on other way. What is that other way? He has given you net profit, no? He has given you what all expenses are incurred in the company, in the entity as a whole. If I work backwards, if I keep adding back all of them, I get to know what is my gross profit. Generally, all items up to gross profit would be done based on sales only. Purchases what I make is proportionate to sales. Manufacturing expenses proportionate to sales. Carriage inward proportionate to sales. That means whatever revenue and cost what I incur up to GP is going to be almost both matching. In which case, if I try to apportion GP based on sales ratio between pre and post incorporation periods, it's done. That means you need to know what is the GP first. You need to know what is the GP first, for which we will be working backwards here. Why are we working backwards? Because directly information is not available. We are trying to work backwards. Okay. So with this, let's go ahead. Working note 3. Working note 3. GP calculation. Okay. So start with net profit given. Net profit given is how much? 2 lakh rupees. Yes or no? 2 lakh rupees. And add all those expenses which he has given you. He has given you multiple expenses there. Please see, depreciation he has given you, add it back. Depreciation is 1,23,000. Please add it. Then you have director fees. Add it, 50,000. Preliminary expenses 12,000 added. Then office expenses 78,000 added. Okay. And then yeah, selling expenses are there. Selling expenses are 72,000, and interest is there 5,000. Okay. Yeah, he has told you something about it. We'll discuss. Okay. So when you add up all these, please tell me how much you got. Use your calculators. Tell me, please. 5,40,000. So this is my gross profit. I'll repeat once again why this GP is required. It is required because I need to know. I am generally supposed to do it from sales. From sales, I'm supposed to start, but since the information regarding the cost against sales is not given, I'm directly moving ahead to GP. Okay. From GP, I'll work towards identifying my net profit, which belongs to pre-incorporation period and post-incorporation periods. Now, so all the information is ready. All the information is ready. Now let us get ahead with the actual solution, calculation of pre and post incorporation profits. Take it as a heading. Okay. I will tell you the numbers. I'll tell you the columns which you are supposed to maintain. Please follow that. Okay. Take particulars. Yeah, there is a question here. What is point of finding GP, because we know only net profit for apportionment? Okay, sir. Yeah. So we need only net profit for apportionment. I do agree. But the problem, what has happened here is there are few expenses which are incurred only during pre-acquisition period. There are few expenses which occurred only after post incorporation. Okay. So to take them in respective places, I need to know how much GP is there. Base. Bilal, is that clear? Okay. So take these columns, particulars, then amount, basis, okay, pre-incorporation period and post-incorporation period. These are the columns what I want. Okay. Now start with GP. Where did you do it? Working note 3. Give that reference. Give that reference. Okay. Now GP is 5,40,000. Now what is the basis for you? It is sales ratio, because GP is generally dependent on sales made. Okay. Sales ratio is how much? Yeah, 2:7. Very good. 1,20,000. 4,20,000. Very good. Next. From this, deduct each of those expenses what are given there. Okay. Let's start with the first one. There is depreciation given there. Yeah, depreciation, what is the basis? First take amount column, full amount, 1,23,000. What is the basis for you? Hello, not sales, time ratio. Very good. Time ratio. Depreciation predominantly on time ratio, unless like Bilal, if they try to twist the question. Okay, it's 1:2. So it's how much? 40? Very good. 82,000. Next. Director's fee. So directors generally will be there only in company. Okay, company got incorporated only from 1st August. So irrespective of number of months or sales, it is just basically post acquisition period, post incorporation period. So entire amount goes only to post incorporation. Okay, then you have preliminary expenses. Generally, preliminary expenses are incurred to start the company. Okay, so entire 12,000 is post only. Okay, then you have office expenses. Office expenses total is 78,000. Generally, office expenses are time based. Okay, so it is 1:2 ratio. It is 26,000 and 52,000. Very good. Then you have selling expense. Selling expense is 72,000. Yeah, selling expenses are based on sales, because only for sales we do incur that expenses. So it is 2:7. Very good. And what is the amount? 16,000 and 56,000. Very good. Okay. And then what other items do you have? Please note this. Interest to vendors. He says up to what date? 31st August. That means from 1st April only up to 31st August this interest is occurred. How much is it? 5,000. Okay, this is not dependent on sales ratio. This is not dependent on time ratio. Of course, time ratio is important, but it's specific. There is some special information which is given. That special information is actually actuals based. Okay, he has stated that it is for 5 months, and out of those 5 months, 1 month is post acquisition period, 4 months is pre acquisition period. So in that case, it is going to be, yeah, sorry. It is basically 4:1. It is 4,000 and 1,000. Okay. Then, is there anything else left? Nothing. That's all. So let us go ahead now. So, what is the net profit you arrive at here? Net profit is, yeah, total happens to be the same 2 lakhs, right? And pre-acquisition period profit happens to be 33,000, and post-acquisition is 1,67,000. Now, what do you do with this 33,000? This 33,000 is basically pre-acquisition profit. It is profit which I have earned not for my efforts. Hence, it is a one-time profit, capital profit. Hence, we take it to capital reserve. Okay, transfer to capital reserve. Okay, this is our normal profit. Yeah, it is taken to P&L. Clear? Boys and girls, hello, respond. There are 40 people. Okay. Okay. So this is the first problem. Now let's get into second question. Another question. Problem number 3, please pick up. We will do this problem and leave today. I will read out the problem, please see. Yeah, so here is a question stating that I did not understand why we are arriving at GP and then doing again. Yeah, I'll repeat that part once again, please see. See, in the question, what he has done is he has directly told you this net profit of 2 lakhs. But the fact is this 2 lakhs is the profit what I have in my company's P&L. I cannot take it like that. I cannot let it be in my P&L completely like that. I need to know how much is the profit which belongs to pre-acquisition period and how much belongs to post-acquisition period. For that, what I need is I need to know what is the sales made before the acquisition and what is the sales made after acquisition. I need to know what are the trading costs or purchase costs, material costs, and all what has happened before purchase of this company or before incorporation of this company and after incorporation of this company. But that information is not available with me. That information is not available with me. Hence, what I have done is there are few expenses here. There are few expenses here which are incurred in specific places. For example, if you see director fees is incurred only after post acquisition. Okay, or else if you see preliminary expenses, these are incurred only after acquisition. Or office expenses, if you see the basis is 1:2. There are different bases for each of these items. You cannot directly go and tell that out of 2 lakhs for the first 4 months the profit earned is belonging to pre-acquisition period. Out of 2 lakhs, the remaining 8 months profit is post-acquisition period. I cannot tell that. For which, what I did is I worked back until sales or sales-related profit. Okay, I worked back until sales or sales-related profit, and from there I have taken each of the expense based on their individual parameters and arrived at what is profit or loss in these 2 periods, that is pre-acquisition, post-acquisition period. Did I make sense, Bilal? Yes.
The net profit now. So we took GP and then net profit and then sales ratio, and then we have less now. Then we add and like we go to the backward way, then we get GP also in the less. We go to the.
I didn't get you once again.
So the GP, we have calculated GP now. We said that we can do the net profit and add all the expenses to the arrive at GP now.
That's what we did first. Now working note. This net profit to GP ratio, GP working out is basically that only, right? We first did that and then we work towards net profit. Bilal, is that clear for you? All right, thanks. Cool. Let's go to the next question. Please read the third question. I'll read out. You read along with me. Lotus Limited was incorporated on 1st July 2021 to acquire a running business of field goods with effect from 1st April 2021. During the year 2021 and 22, the total sales were 48 lakhs, of which 9,60,000 were for the first 6 months. The gross profit of the company is 7,81,600. Expenses charged to P&L statement include director fees, bad debts, advertisement, salaries and general expenses. Advertisement, he says something under a contract amounting to 4,000 per month. Preliminary expenses written off 20,000. Donation to a political party given by the company 20,000. Prepare a statement showing pre-incorporation, post-incorporation profits for the year ended 31st March 2022. So this is a problem which is similar to the previous problem. However, he has specifically told you what is the sales made in the first 6 months, and the GP is also mentioned. That means based on that sales amount which he has given, we are supposed to calculate time ratio, sales ratio. Okay. So let us first do that. So your steps are going to be: number one, calculating time ratio. Time ratio is fairly simple here. From 1st April to 1st July, that is 3 months. April, May, June. And from 1st July to 31st March is 9 months. So 3:9 is your time ratio. Second, with respect to sales, he has told you in the first 6 months it is 9,60,000. So if it is 9,60,000 in the first 3 months, you need to find out in 1 month how much it is. 1,60,000. So for the first 3 months, it is going to be something 1,60,000 into 3 is going to be first 3 months sales ratio, and remaining 9 months you are supposed to find out how much it is. Okay. Yeah, we will do that. I'll do that. And lastly, again here also he did not tell you what are your expenses relating to sales. So again we'll have to go backward and first calculate what is GP. Yes or no? Oh, GP is given, huh? Acha, fine. GP is already given. That's fine. So I need not calculate GP. I can directly start with GP, taking sales ratio as base. Okay. So with this, let's begin. So problem 3. Page 1. Working note 1. Time ratio. So time ratio, again, write down 2 bullet points. First bullet point is pre-incorporation period is from 1/4/21 to 1/7/21. It is 3 months. Post incorporation period is from 1/7/21 to 31st March 22. It is 9 months. Okay, so it is basically 3:9, which you can also call as 1:3 as time ratio. Okay, next, working note 2, sales ratio. Okay, please be cautious here. Here sales ratio finding out is not similar to what we did last time in the second problem. Here you are supposed to find out sales made from 1/4/21 to 30th of June 21. 3 months period. Okay, so how do I do it? He has told you that 9,60,000 is the sales made for 6 months. Out of first 6 months, out of that first 6 months, I only need 3 months sales. So it is going to be 9,60,000 into 3 divided by 6. How much is it? 1 lakh? No, 1,60,000 is per month. No. Yeah, it is basically 4,80,000. So first 3 months sales is 4,80,000. Okay. Next, sales made from 1st of July 2021 to 31st of March 22. I want. For this, there are 2 things which I am supposed to take. Out of that 9,60,000, 3 months sales is there, because from 1st April to 30th June I have taken as pre-acquisition period. Post-acquisition period sales is also there now for 3 months. From 1st July 2021 to 30th September 21, there is 3 months sales, okay, which is again 4,80,000 plus post-acquisition period sales. How do I know post-acquisition period sales? He has told you the total sales during the financial year is 48 lakhs. Out of that 48 lakhs, I have set aside 9,60,000. Okay. So the difference between that and this 4,80,000 is basically my post-acquisition sales. So how much is it? 38,40,000. This is 43,20,000. The same 43,20,000 can be found out in another way also. What is that? He has directly told you this is option 1. Here's option 2. He has told you 48 lakhs is your sales. From that, if you deduct the first 3 months sales, 4,80,000, you get the same 43,20,000. Either way, at your comfort, you can do. Okay. So now if you see these sales numbers, can you tell me, is there any ratio here? Okay, 432 divided by 48, please see. 9 times, huh? Okay, so the ratio is basically 4,80,000 is to 43,20,000, and the ratio happens to be 1:9. Sales ratio is 1:9. Did you guys understand? Boys and girls over there, please respond. Okay. All right. Yes. Thank you. Let's move ahead. Freedom on it, I think. Comfortable. Now let's get ahead with our answer, the pattern in which we present. Okay. Take particulars. So again, heading, please write down. Computation of pre and post incorporation profits. Particulars, amount, basis, pre, post. Okay. So let us directly start with GP given. GP given is 7,81,600. This is supposed to be done based on sales. Sales is 1:9 ratio. Sorry, Nana. Is that so? 1:9. Hello. It is going to be 78,160. No, totally is 10. 7,81,600 into 1 divided by 10 is 1:9 means the total is 10, no? 78,160 and balance please 7 lakh something. 7 lakh,
3,000.
okay. 7 lakh 3,440. Thank you, Bilal. Then from here we will deduct all the expenses less. What expenses do we have? So start with director fee, which is given 60,000. This is only after incorporating company, so it is post. Okay, and then you have bad debts given there. Bad debts are generally incurred based on the sales made. Okay, so yeah, 14,400 is what's given. The ratio is going to be 1:9, 1,440 and 12,960. Thank you. Next, advertisement. Did he tell you anything about advertisement? Yeah. So if you see carefully, 60 or 50, yeah? Oh, sorry, 60. Okay, sorry. 60. Okay, thank you. Yeah, advertising, if you see carefully in the question, he says advertisement 48,000 under a contract amounting to 4,000 per month. Had he not given that extra explanation, what would we do? We would do it based on sales ratio. Okay. So since he has specifically mentioned about the standard number, we are going by time. Okay. So it's going to be 48,000 in the ratio of time. What is time ratio for us? 1:3. 12,000 and 36,000. Very good. Next, salaries and general. Okay, general expenses. It is a total of 2,56,000 and ratio, generally it is time ratio. It is 1:3. 64,000 and 1,92,000. Very good. Okay. Then preliminary expenses. In what ratio? It's always post. Very good. Then donation. How much is the donation? 20,000. That also is post. Very good. And finally, arrive at net profit. What's net profit? Sorry, total net profit is 3,63,200. It is 720 pre, and post is 362 480. 362 480, right? Yeah, I am doing based on the totals. Okay, so where does this 720 go? Very good, capital reserve, and this goes to P&L. That's all. Okay, so let us stop here for today. I will not bombard you with too much of problems. First day, let it be little smooth. From second day onwards, we will enjoy more. Any doubts, boys and girls over there? Hello? Clear? Very good. Fine. Yeah. Why is donation post incorporation expense? Very good question. So logic is very simple. If you look at the uh, the question given, donation to political party given by the company, he specifically mentioned that it is given only by the company. Yeah, so that's the reason you are taking it only to post incorporation. Okay. Not really required, ma. Should be right. Pre-incorporation goes to capital and post-incorporation goes to P&L. Not really required. In fact, if he specifically asks in the question, then we will mention that we are writing here, we are pulling it out and writing only because just for your clarity, that's all. Okay. Repeat the ways apportionment can be done. Okay. So generally, items which are dependent on sales, be it sales, or there could be other incomes which are dependent on sales, or there could be expenses which are dependent on sales, like be it purchases made, or else you may have expenses related to sales, like advertisement cost or as marketing cost, bad debts. These are items which are related to sales. Any item something related to sales would be appropriated based on sales ratio. And then when it comes to time ratio, some fixed costs which do not vary even if sales happen or do not happen, those would be done based on time ratio. What type of expenses? There could be rent which is paid, or else stationery incurred, or else there could be salaries which are paid. These are static irrespective of the sales made or revenue generated by the company or by the business as a whole, in which case those would be considered for your time ratio. And apart from that, there could be expenses which are specifically incurred only after incorporation. Okay, or else for the sake of incorporation, preliminary expenses, it's incorporated only for the sake of company. Or else there could be your post incorporation expenses, audit fees could be there, or else there could be directors fees, directors remuneration specifically mentioned there. In such case, those will be taken only to post incorporation period. Other than that, you may also have pre incorporation expenses specifically pertaining to before incorporation. Those would go only to pre incorporation period. Clear? Krishnu Adityan. Yeah, thanks. Okay. Okay, guys. I hope you're fine with the session. If you want me to increase speed, let me know. Or if you feel the speed is too high, let me know. Since this is the first class, we will understand each other better. Yes. So you can text me or WhatsApp if you feel you guys are not yet comfortable. I'll take care. So we will end here for today and take it up forward. Thank you. Bye-bye.